September 15th, 2008. The morning began like any other. But by nightfall, one of the most powerful banks in America had ceased to exist. Lehman Brothers, 158 years old, with offices in every financial capital, was gone. The collapse wasn't just a headline, it was a shockwave. Markets froze, credit evaporated. Millions of people who had never heard of Lehman Brothers suddenly felt its death in their paychecks, their pensions, their homes. So, how does a bank that survived the Civil War, 2 World Wars, and the Great Depression vanish in a single weekend? The answer lies in a dangerous cocktail: leverage, blind confidence, and a housing bubble that everyone thought could never burst. Lehman's business model was simple in theory, reckless in practice. They borrowed money, huge amounts of it. They used that borrowed cash to buy mortgages, bundle them into securities, and sell them as safe investments. It was financial alchemy, turning risky loans into gold. Or at least, that's how it looked. Here's the math nobody wanted to face. Lehman was leveraged 30 to 1. For every dollar it actually owned, it borrowed 30 more. Imagine balancing a skyscraper on a single toothpick. That was Lehman's balance sheet. When housing prices rose, the system looked genius. Investors lined up. Ratings agencies stamped AAA on products they barely understood. Lehman's profits soared. Executives collected bonuses that could buy islands. It was theater, and the audience applauded. But in 2007, the script flipped. Housing prices stalled. Mortgages defaulted. Those safe securities turned toxic. Suddenly, the skyscraper wobbled. Lehman tried to reassure everyone. Press releases insisted the firm was strong. Conference calls painted optimism. Behind the curtain, the numbers were bleeding. Billions in losses. Assets no one trusted. Confidence drained away. Here's the absurd irony. Lehman still claimed $600 billion in assets. But assets are only valuable if someone believes they are. And by September 2008, no one did. Counterparties refused to lend. Investors fled. In finance, trust is oxygen. Lehman suffocated. The weekend of September 13th was chaos. Government officials scrambled. Could Lehman be saved? J.P. Morgan and Barclays circled. But the deals collapsed. By Monday morning, Lehman filed for bankruptcy, the largest in U.S. history. The fallout was immediate. The Dow Jones plunged 500 points in a single day. Money market funds broke the buck. Global credit markets froze. Ordinary businesses couldn't borrow to make payroll. The collapse of one bank rippled into the collapse of trust itself. And here's the bigger truth. Lehman wasn't unique. Bear Stearns had already fallen. Merrill Lynch was desperate. AIG was imploding. Lehman became the symbol, but the disease was systemic. Wall Street had engineered fragility, disguised as prosperity. Why does this matter now? Because the mechanics haven't disappeared. Leverage stacked on leverage, risk disguised as safety, confidence treated as collateral. The skyscraper still stands, balanced on that same toothpick. Governments patch the system with bailouts and new rules, but patches aren't cures. Debt remains the fuel. Trust remains the oxygen. And when trust breaks, math doesn't save you. Lehman Brothers collapsed in a single weekend. But the real collapse was of belief. The belief that financial engineering could defy gravity forever. So here's the unresolved question. Was Lehman's death the final warning? Or just the rehearsal for the next global collapse?